All right. Hello and welcome to yet another video series for CFA Level 2. My name is BJ Tolia. I am the Vice President for CFA Education at Kaplan Swayze. Basically in that role, I'm responsible for authoring and editing the Level 2 portfolio. Brief background about myself. I am a CFA charter holder, a PhD in finance, and have been doing this for longer than I would like to admit. Continuing on, though, let's get started with corporate finance. So, if you have been following this material sequentially, you would have realized that you have really gotten over one major hurdle in Level 2, and that's your financial reporting and analysis material. Now, it'll seem to be a little easier, right? Well, I need to always check myself. Nothing is easy in the CFA Level 2 world, but relatively speaking, it'll feel a lot less stressful as compared to the accounting material. All right, so the first reading we're going to talk about today is capital budgeting. Capital budgeting is the process by which companies make decisions about which long-lived assets to invest in, which projects to invest in. All right, so you have seen some of this material at Level 1. Some will be familiar to you, but majority of it is new material. It could get complicated. Therefore, I would pay extra attention to this specific reading in corporate finance. All right, so let's talk about the principles of capital budgeting. The principles of capital budgeting essentially set up kind of a formal set of rules that we need to be aware of before we go out and do capital budgeting. The first rule is decisions are based on incremental after-tax cash flows. So what I want you to do is to underline incremental and cash flows. So again, decisions are based on incremental after-tax cash flows. And what do we mean by incremental? First of all, we recognize the difference between cash flows and accounting income. That's pretty straightforward. That's very mundane. However, what do we mean by incremental? Incremental is the difference in cash flows between when we accept a project versus when we reject a project. So, when we accept a project, there will be one set of cash flows. When we reject the project, there will be other set of cash flows. The difference between the two is precisely the incremental cash flows. So, keeping that background in mind, let's talk about sunk costs. Sunk costs are considered to be non-incremental or not relevant to our analysis. Why? Because sunk costs, by definition, would have been incurred, would have been spent, regardless of whether we accept or reject the project. So, if we accept the project, the sunk cost would have been $100,000, for example, and if we reject it, still $100,000. That cost does not change. It is already incurred. It's already spent. And therefore, there is zero change. There is zero incremental cash flow. So that is your first element, sunk cost. The second element that we will need to talk about is externalities. Externalities are other influences on a project's cash flow. We consider them incremental. So there could be positive or negative externality. A good example of a negative externality is cannibalization. So for example, when Coca-Cola was introducing Diet Coke in the market, one of the things it needed to be able to evaluate was cannibalization of sales of regular Coke. So when you do a capital budgeting analysis, when a company does a capital budgeting analysis, one of the things it needs to evaluate, one of the things it needs to include in its evaluation has to be any cannibalization or any externality. Positive externality is positively influencing the company because of the project. So what I mean by that is the project is contributing some additional incremental benefit beyond what is directly obvious. So for example, when a company introduces a new product, let's say a new copier is introduced by Xerox, well, it's not only the revenues from that copier, but the revenues from any toner or any other supplies that go along with this new product that needs to be included in our analysis. So all of this again is more or less qualitative material that we are trying to understand. Once again, the basic principle still remains, and that is the cash flows have to be incremental. So incremental cash flows, again, are the cash flows that are difference between if we accept versus reject the project. Now, also, we recognize that the timing of cash flows is important. So for when we do capital budgeting, the period to which the cash flow belongs has to be allocated accordingly. So we don't want to assign cash flows in year 5 to year 4. Why? Because time value of money. Nothing special there. Another important point to keep in mind is financing cost is already reflected in the required rate of return. So unlike accounting, we don't deduct interest expense when we generate our cash flow estimates. So interest expense do not include in our capital budgeting. That's all we need to keep in mind. So treat projects as if all equity finance is more like a shortcut or easy way out. It is not technically accurate, so keep that in mind. What we mean by all equity finance is simply that we are not going to include any interest expense in our analysis, even if we are given. And typically, that will be a good red herring that you will be provided with, but that you should be ignoring when you generate your cash flows. All right, so let's do a first evaluation of a simple expansion project, okay? So we will do that, but first we need to again set up some sort of a ground, some sort of a framework to evaluate project cash flows. The first thing we want to talk about is typical case scenario. We're going to do evaluation of project cash flows in 3 stages. All right, so what are the 3 stages? The first stage is your initial outlay. That's your negative cash flow or cash outflow. So initial outlay is your negative cash flow. You're going to enter that as a negative number in your financial calculator, and that is your cash outflow. That's the investment that you need to make. The second element, the second stage in our evaluation is computing the after-tax annual operating cash flows. So what it is on a recurring basis, the project generates a certain amount of cash flows. Those are your after-tax operating cash flows. Now, these are positive, they are cash inflows, and are entered in our financial calculator accordingly. And then the last thing to keep in mind is your terminal year cash flow. That's the cash flow that occurs towards at the end of the project's life. Typically, this is recovery of net working capital as well as salvage value when you sell any capital assets that were acquired as part of the project. All right, so let's look at an example for evaluation. So once again, first of all, the outlay is fixed capital investment plus working capital investment. Fixed capital investment is simply the cost of your fixed capital, includes any shipping cost to put the asset in place. It's very similar in principle to when we computed depreciable basis at level 1. So fixed capital investment is simply the cost of fixed asset that is required to be invested for this project. That's your initial outlay. In addition to it, the project may call for additional net working capital. The key word here is additional. So I don't want to burden the project with all the net working capital that the firm already has. I'm only concerned about additional net working capital that is required if we accept this project. And what is this net working capital amount? Well, the way you compute it is simply looking at the change in non-cash current assets minus the change in non-debt current liabilities. So once again, the deltas here represent change. So you have non-cash current assets. Let's say non-cash current assets were $1 million and they increased to $1.1 million, then the difference between the two is $0.1 million. So the change in non-cash current assets minus the change in non-debt current liabilities. Non-cash current assets is simply current assets minus cash and cash equivalents. So you're looking at accounts receivable, inventory, those kind of things, okay? Now, non-debt current liabilities, essentially you're excluding interest-bearing debt, typically notes payable. So you're looking at accounts payable as a good example of a current liability. So you're again looking at the change in current assets minus change in current liabilities. That's your additional net working capital investment. All right, the second, the after-tax operating cash flow. Let's define that precisely. The cash flows can be defined in 2 ways, and they are identical. Mathematically, they are the same. So the first equation is sales minus costs minus depreciation times 1 minus T plus D. Now, recognize we started out, we said we are not doing accounting, we are doing what? Cash flow estimation. Well, if we are doing cash flow estimation, why are we deducting depreciation? The S and C are both cash based. So sales are not accounting sales, they are cash revenues or cash collections, minus cash operating expenses, minus depreciation. The only reason we include depreciation in our analysis, we recognize it's a non-cash expense. The only reason we include it is because of tax shield. So the depreciation is giving you a tax shield or tax savings, and that is the only reason it is part of our analysis here. All right, so another formula, mathematically equivalent, is S minus C times 1 minus T. So that is your after-tax income. Again, I'm not including depreciation here in the first part of the formula, and I'm simply only including the depreciation tax shield. So the T times D is exactly mathematically equal to the depreciation tax shield. Again, the two formulas are identical. One small point to keep in mind is S minus C minus D is nothing other than EBIT, okay, operating income. So it's nothing other than EBIT. Remember, we are not subtracting interest expense. So it is very similar to EBIT, and I'm going to be a little more precise, and I'm going to call it the cash EBIT because everything here is cash except for, again, depreciation. All right, so those are the elements to keep in mind. Also, why do we have two formulas if they both are identical? They are mathematically the same. If I rearrange the letters, it will come to the same thing. So why do I have two formulas? Well, because depending on how the prompts are actually engineered, meaning how they ask you the question based on the way they provide you the input data, you may be forced to use one or the other. So be prepared to be able to use either of the two equations. All right. Now, the last cash flow, the terminal cash flow, we call it the terminal year non-operating. These are not recurring cash flows. This is a one-time deal. So what are the non-operating cash flows at the end of the project's life? We have salvage value. Okay, we have the salvage value, meaning the price at which we are going to be able to dispose of our fixed asset. Then we have the working capital investment. We should say return of net working capital or recovery of net working capital. Because it's a recovery, it's a cash inflow, therefore the positive sign. And then whenever you have salvage of fixed asset, don't forget one thing, and that is what? The tax implication on salvage. So anytime there is a sale of fixed asset, do not forget the tax implications. So that is the key, that is the important element that we should not lose sight of. And what is the tax on salvage? Well, based on the book value of profit. So what we have is times the tax rate times the salvage value minus the book value. Now the book value is per tax books, okay? So if in the tax books we are recognizing depreciation expense using maker's classification, then we use the book value according to maker's classification. So the book value again is based on the makers or whatever the tax books may specify. Again, the depreciation expense in the previous slide is also based on tax books, not based on financial accounting books. All right, so let's look at an example for expansion project. So expansion project is simply an independent project that is not based on or is not influenced by any other project. So we'll talk about mutually exclusive project in just a little bit, but right now let's talk about an expansion project. Expansion project is simply, again, as I said, an independent project. Here in this case, in this example, we are given that the project cost is $450 million. That's your initial outlay, that's your fixed capital investment. This cost will be depreciated straight line to zero over 3 years. Presumably, that's your tax accounting. So we are going to claim $150 million per year as depreciation for tax purposes. That's what is given to us. Additionally, we are given the working capital increase of $25 million. So they have directly given us the change in working capital. We don't need to compute it, and that is our net working capital investment. So that is given to us again as $25 million directly. Now, your further given can be sold in 3 years for $50 million. What it really is talking about is, once again, your original $450 million asset. We are estimating that in 3 years' time, it will be sold for $50 million, and we will need to look at the tax consequence for it. All right, you're also given paid outside consultant $2 million for the detailed market share and cost analysis. We'll talk about that in a little bit. All right, furthermore, we are given the incremental revenue from this project is $400 million per year, and cash operating expenses is $200 million. So that's your S&C, and you're given the cost of capital is 20%, the tax rate is 40%. You're asked to compute the NPV and IRR. All right, let's plug these numbers in. All right, so first thing we do is to compute the stage 1 cash flow, your initial outlay. Initial outlay, pretty straightforward. Your fixed capital investment of $450 million given to us directly, $25 million net working capital given to us directly as well. So we have a total outlay of $475 million. Once again, when we enter this in our calculator, make sure we enter it as a negative number for CFO. All right, continuing on, your annual operating cash flows. So your annual operating cash flows can be computed one of two ways. We are looking at the second mechanism, the second formula here in this example. So you have revenues minus cash expenses, and then we take it after tax, and then finally add the depreciation tax shield. We get the total cash flows per year of $180 million. Remember, this is annual cash flows, and this will reoccur every year for next 3 years. All right, we could have done this using the first formula. Let's do it just for the sake of example. So S minus C minus D times 1 minus T plus depreciation. So this is our first formula. In this case, we are given the data, so we could use either one. We had a choice. And so I'm going to do the second method, or actually the first formula method. And 1 minus the tax rate is 0.6, and depreciation once again is 150. So when you do it the second way, once again, you will come to the same value of $180 million, all right? And it should always be, because those two formulas are mathematically identical. All right, having said all of that, let's go on to computing the terminal year operating cash flows. Non-operating cash flows, I'm sorry. So terminal year non-operating cash flow, that's your salvage value plus recovery of net working capital. And again, whenever there is salvage, we need to consider the tax consequence. In this case, there is a $20 million additional tax liability. Why? Because the book value per tax book is 0. Why 0? Remember, we purchased the asset for $450 million. We have been depreciating at $150 million per year. And so we have totally depreciated 3 years worth of depreciation, and its book value will be 0. All right, so the tax on that, $50 million, is fully taxable. Tax on that is $20 million, and so we get net terminal year non-operating cash flow of $55 million. All right, so all we now have to do is to plug this data in our calculator and compute the IRR/NPV as expected. Now, a couple of things to keep in mind before we go into the computation part. A couple of things to keep in mind is make sure to only use incremental cash flows. That's exactly what we did. One of the things we did was we ignored, excuse me, that consulting fee. Why? Because that is sunk cost. Sunk cost means, again, that cost does not change whether we accept the project or reject it. All right, so we also looked at the impact of depreciation. We talked about it earlier, that even though depreciation itself is a non-cash expense, but it has a tax shield consequence, that is a tax saving consequence, and that's why we don't ignore depreciation. So our cash flows are initial cash flow of negative $475 million. We have years 1 and 2 of $180 million. And year 3 is that standard 180 plus the 55, which is our terminal year non-operating cash flow. So the last year is 235. Why? Because again, you have 180 plus 55. Okay. So we plug this in our calculator. We get the NPV to be negative 64, and IRR is 11.6%. Now, in this case, this is an independent project. It is not dependent on any other project. There is no influence of any other project here. We are not making a choice, and so it's an independent project. Not only that, your cash flows, the project cash flows, are conventional cash flows. What is conventional cash flows? Again, refresh from level 1. Conventional cash flow is where there is only one sign change. You have initial cash outflow, and then later on it's all inflows, all positive cash flows, okay? So if in a conventional cash flow, independent project, NPV and IRR will give you the same decision. Again, both will tell you in this specific case that the project should be rejected. We don't want to accept this project. All right, so that is your expansion project example. Let's move on to the concept of a replacement project. Replacement project is when you have an existing equipment, existing plant, existing machinery, and you want to replace it with new plant, new machinery. So what is the type of analysis this type of a scenario entails? So some of the differences to keep in mind before we go into the precise cash flow estimation. Some of the things to keep in mind. One is, whenever we do a replacement, we have to sell the old equipment. So when you say replacement, means what? Selling the old, buying new. It's both things combined that defines replacement. So you sell the old equipment, which essentially means that your initial outlay is accordingly going to be offset by the inflows from the sale of the equipment. The second element is depreciation. We only use the difference between the old and the new depreciation. Once again, we are only concerned with incremental cash flows, and we'll see this in just a second. So just like everything else, we are only concerned with incremental, or the difference in cash flows. All right, operating cash flows, no difference here. Once again, our keyword here is incremental, meaning the difference between if we replace versus if we don't replace. That is the key. If we replace versus not replace. So it's not new versus old, it is replace versus not replace. And that is the philosophy that you need to keep in mind if you want to do a replacement analysis. All right, so let's look at the cash flows if we replace. So if we replace at the beginning of the project, meaning upfront, initially, year 0, you have fixed capital investment, which is basically your new project or new equipment cost. Any additional working capital, so the new equipment may have additional working capital beyond what the old asset may have required. In that case, that is your additional net working capital. And then minus the salvage of the old equipment, and anytime there is a salvage, always consider the tax consequences of the project. So what happens, the reason I have a positive sign here for tax is because we are considering the salvage value of the old as an offset for against the new investment. So it is basically salvage minus tax, and I've opened the parentheses, and that is why you see a positive sign for the salvage. All right, so having said all of that, again, if you replace the project, you have the new machine offset by the salvage value of the old machine after tax, and then you have the net working capital if applicable. If you don't replace, if you have maintain the status quo, you don't do anything, there is zero. If you don't do anything, sorry, there is zero cash flows applicable. Okay, now you take the incremental cash flow. Incremental cash flow is what? You have column 4 is equal to column 2, sorry, minus column 3. So your column 4 is equal to column 2 minus column 3. That's your incremental cash flow, the difference, okay? All right, so we continue on for the next years, meaning your year 1 to T, that's your second stage cash flows, your regular annual operating cash flows. All right, so we have NS minus NC. What is NS? NS is the revenues from the new equipment, so N stands for new, and NC is the cost from the new equipment. So you have the new revenues minus new cost after tax plus new depreciation tax shield. This is if we replace, okay? That's what will occur if we replace. Again, the presumption here is the revenues and expenses are not going to be the same as if we had the old equipment. So that is your regular operating cash flow if we choose to replace. We have new machine, the new machine numbers come into play. If we continue with the old machine, meaning we did not replace, and R stand for not replace, if we continue with the old machine, then we will have old revenues and old expenses after tax and old depreciation tax shield. Notice the formula that I've used is your second formula out of the two formulas that we talked about. All right? So the change between the two, column 2 minus column 3, is where we get this deltas from. So your the change in revenue minus change in cost after tax plus change in depreciation tax shield. This is what my point 2 in the previous slide was talking about. This is where we talked about use the difference between the old and the new depreciation. That is where the last term is coming into play. So we are only looking at incremental depreciation or change in depreciation. All right, so then it brings us to the third stage. That's your last stage. And the last stage is what? Your terminal year cash flow, the cash flows that occur at the end of the project's life. Now, we have the new machine, so we have new salvage, plus recovery of any net working capital. Once again, even in expansion project, the recovery of net working capital was a positive sign. Same thing here. Also keep in mind, when you have recovery of net working capital, the amount is going to be identical. So if you put in $25 million up front, you get $25 million back at the end of the project's life. And then finally, we have to subtract any tax consequences. Remember, anytime there is a salvage, there has to be an evaluation of tax consequence. All right, so that is the scenario if we choose to replace. If we choose to not replace, then the scenario would be what? We would have old machine salvage. Okay, so we would have not sold the new machine because remember, we did not buy the new machine. We did not replace. In that case, what would we have? We would have the old machine. So we would look at the old machine salvage, and then we have to obviously take into account salvage, the tax on salvage. That's your second term in that equation. All right? So now the last column is incremental cash flows. All we are doing is doing the difference between column 2 and column 3. And so change in salvage, net working capital just carries over, and then minus tax on, again, everything is delta. Okay? The tax on change in salvage value minus a change in book value. So that gives you the last terminal year cash flow. Now, the key here, the one thing to keep in mind is that oftentimes candidates freak out because, and it's a common source of confusion, and that is, well, wait a minute, we did say that we sold the old machine in year 0, or why are we having salvage value of the old machine in year T? That is again because we don't want to look at new versus old. Instead, we want to look at replace versus not replace, and that is the key here. So don't get into the mode of new versus old. That's an easy way to make an error. All right, so what about the impact of inflation on our capital budgeting analysis? Okay, a couple of things to keep in mind. Whenever you're evaluating nominal cash flows, just match nominal discount rate. So nominal cash flows use nominal discount rate. The numerator should match with the denominator. Pretty straightforward. If you're using real cash flows, use real discount rate. And you have a choice. You can use either one. Generally, we just stay with nominal because it's easier. Why do you, if you're not going to be affected by, if the real numbers are not going to be necessarily giving you a better quality of decision, why bother? So usually we stick with nominal, but you have a choice. You can use either one, but we have to be careful. We have to match the discount rate with the cash flows. All right. Now, continuing on, the key here in this LOS is what if inflation is higher than expected? Okay, so what if the actual inflation turns out to be higher than what we expected? Expected meaning when we started out the project. All right, so first element, and that is the key. The first two are actually very important, and that is it reduces the value of depreciation tax shield. Why? Remember, depreciation tax shield is what? Tax rate times depreciation. The depreciation amount is based on nominal cash flows, based on nominal amounts. So it is actually computed using what? The original cost. It is not based on restated or inflation adjusted cost. So the depreciation amount is nominal, and therefore the tax shield is also in nominal dollars, and that does not change. It is static regardless of the inflation. If inflation is 0 or if inflation is 100%, that amount is constant. Obviously, higher the inflation, you're going to be reducing the real value of depreciation tax shield, and so it would be more precise to call it reduces the real value of depreciation tax shield. All right, continuing on, it also decreases the value of fixed payment to bondholders. And this is again always the case. We will talk about it in elsewhere in the curriculum as well, but always whenever inflation is higher than expected, there is transfer of wealth from the bondholders to stockholders. Why? When the bonds were originally issued, the bond investors priced expected inflation, expected based on the expectations at that time, so priced the expected inflation into the required rate of return, into the yield of the bond, into the interest rate on the bond. All right? So once the bonds were issued, the inflation amount, the actual inflation can change. It could be different. If inflation is higher than originally priced, then the bondholders suffer. If inflation is lower than what was priced, the bond investors will benefit. So that is a converse side to it as well. However, here we are only concerned with if inflation is higher than expected. So that is the only focus of the LOS here. So we say that it reduces the value of the fixed payment to bondholders. They are getting nominal dollar amount back. They are getting contractual fixed interest and contractual fixed par. And those values in real terms will be lower if inflation is higher. The last element is different impact on revenues versus costs. Well, obviously, depreciation is going to be different, in an inflationary environment. Depreciation would be the same, in an inflationary environment as compared to lower inflation or high inflation versus low inflation, no change in depreciation amount. So there will be a different impact on revenues versus costs. Some part of the inflation can be passed on to the customer, some part cannot. Similarly, some of our expenses may be more sensitive to inflationary pressures, meaning they'll go up with inflation. Some costs can stay more stable, can be less impacted by inflation. Bottom line is, the main two things that you need to keep in mind for this LOS is inflation. If it is higher than expected, it will reduce the real value of depreciation, as well depreciation tax shield, as well as it reduces the value of fixed payments to bond investors. All right, so now we're going to move into a special case scenario for capital budgeting, and that is when you have projects with unequal lives. This is basically going to be applicable to mutually exclusive projects. What is mutually exclusive? When two projects are mutually exclusive, you're forced to make a choice. You can't accept both of them, or you can't reject both of them. Well, you could reject both of them. Depending on the scenario, you may be forced to choose one. For example, if you're required to make a safety modification to meet with law, in that case, you may be forced to choose one of the projects, even if it is a negative NPV. So mutually exclusive means simply that you have to choose, okay? And here you have two projects that are mutually exclusive. You have to make a choice, and the projects are replaced repeatedly. So, when we get into this method of using unequal lives analysis, there are three conditions that needs to be satisfied. So before we get into the actual analysis part, let's understand the three conditions. The first condition is that the projects have to be mutually exclusive. You can't have both. Okay? So if you don't have to make a choice, then why even bother? Okay? So that is the first part to it. The second part is the project should have unequal lives. So one project is lasting 5 years, the other project is lasting 2 years or whatever. So the second aspect to it is unequal lives, and then the last one is replaced continuously. Okay, The last one is replace continuously, and that is a key element that we don't want to lose sight of. All right, so let's look at an example to get an idea as to how are we going to do these projects with unequal lives analysis. There are two methods to use. We'll first start out with the replacement chain method. We'll move on to the next method. Okay, so let's first look at the data as provided to us about this project. So the NPV of book press directly given to us is $3,245. We're keeping this example simple. We are not computing NPV. The project cash flows are not directly given to us. We don't care because all we need is the NPV. And you're also given that the NPV of the other project, the offset printer, is $2,577. So notice the book press 6-year life, offset press is 3-year life. The reason here that we are confused, or at least the reason here that we are trying to use a different method to evaluate projects, is because the project's life are different. And so to understand this, let's look at an analogy. When you have a positive NPV for a project, think about that project and think about that NPV as simply free money. So in this case, the book press has an NPV of $3,245. It's a positive NPV. Generally, in an independent project kind of scenario, you'd say accept this project, free money of $3,245. Of course, I want that free money. However, in this case, you have to make a choice. It is a mutually exclusive. Would you rather want $3,245 of free money, or would you rather want $2,577 of free money? You would say, well, $3,245 is greater than $2,577, and so you would go with that. But that is not the only thing. The key here, and that is the main thing, do you want $3,245 of free money every 6 years, or $2,577 of free money every 3 years? That is the key, right? So it's not a one-time deal. If it was a one-time deal, I would say, yeah, $3,245 of free money is better. However, it is $3,245 every 6 years, or $2,577 every 3 years. Now this is really an apples to oranges comparison. We don't know which one is better. So we need to make a formal evaluation. All right, so let's talk about two mechanisms. The first one, as I said, is the replacement chain method. We use least common multiple of lives. In this case, there are two projects have a 3-year and a 6-year life. The least common multiple is 6, so we essentially stretch it out over a timeline of 6 years. When we do this, and in this case, the data is actually including the cash flows. We really don't care. We can summarize it using NPV. So if I look at the offset press, remember the offset press has $2,577 of NPV every 3 years. And so I don't need the project cash flows. All I need is NPV. Every 3 years I get $2,577. If I chain them together, the NPV today is $4,412. If I chain them together, the NPV today is $4,412. If I have the cash flows, I can actually compute the IRR, but once again, I really don't care. I don't need to, okay? All I need is the NPV when I chain them together. So how do I get to this $4,412 NPV given these two $2,577 NPV values? Well, you're going to enter your CF0 as, be careful, positive 2,577, and you're going to enter C03 as positive 2,577. Again, discount rate is given to us as 12%. Compute NPV, and you should get 4,412. So that is your chained NPV. Remember the other project, the competing project, we already knew it's a one-time deal over a 6-year life, and it is $3,245. So if I were to compare the two, so book press and offset printer, all right? We have a timeline of 0 to 6. Book press is $32.45 of free money, and offset printer is equivalent to $4,412 of free money. What I've done now is brought both NPVs in 0 time period. Now I can make now I can compare the apple to apple. So it's pretty straightforward. Obviously, I want $4,412 of free money as compared to $32.45 of free money. So I go with the offset press. All right, another way to do it, give you the same conclusion, and that is to look at the EAA approach, equivalent annual annuity. So we're going to look at the equivalent annual annuity approach, and what it is computing the payments. So getting $32.45 every 6 years is equivalent to getting $789 every year. Why? Because if you plug in $32.45 as my present value, n is equal to 6, I is equal to 12, what is my payment? Payment will be $789. Now, by the way, this negative sign is simply because of the convention in the calculator that one of the cash flows has to be negative. Otherwise, there is no reason to put in as a negative $32.45, so don't get confused there. So what I'm trying to do is to compute an equivalent payment figure, annuity figure, that will give me both cash flows, both projects' cash flows in annual numbers. So now, for the offset press, the payment will be $1,073. Why? Because I am computing the annuity over a 3-year window now. So now the question becomes, would I prefer $789 per year, or would I prefer $1,073 per year? Obviously, I would prefer higher amounts per year, and so I would still go with offset press. So once again, it will give you the same conclusion regardless of the method you choose. The only reason we learn both methods is because, first, it is in the curriculum, and secondly, because the way the data is given to you, you may be forced to use one of the other methods. So you need to be familiar with both approaches to evaluation of unequal life projects. Once again, 3 conditions need to be satisfied when you go with unequal lives project. The first condition is they have to be mutually exclusive. Second condition is the project life should not be equal. And then finally, the projects are expected to be replaced at the end of their lives. Another element to capital budgeting is, generally speaking, as a rule of thumb, we say we accept the project if the NPV is positive. What if we have certain number of projects and all of these projects are positive, but when you add up the initial outlay for all the projects, well, you just don't have enough capital to invest. So we come to a scenario, very realistic scenario, and that is capital rationing. Capital rationing is we have a limited amount of capital to invest amongst competing projects. The goal always is to maximize shareholder wealth. How do we do that? We select the portfolio of projects, the combination of projects, such that the collective NPV, we add up the selected projects, their NPV is highest. So the portfolio NPV, which gives you the biggest bang for your buck, is what you should be choosing. So the combination of projects that has the highest total NPV is what you want to do. Now, to do this process of coming up with different portfolios, different combinations, a tool that can be used to make your life a little easier is to compute profitability index. Profitability index is equal to 1 plus the NPV divided by initial outlay. So think about this NPV divided by initial outlay is giving you your bang for your buck, the amount of NPV that you're getting for the investment that you make. You add 1 to it, that will give you your profitability index. That gives you a ranking mechanism that gives you an idea to rank the most profitable project first, and then you use that ranks to come up with different combinations to evaluate the total portfolio NPV. What about project risk? So how do we looked at the cash flows, and these are point estimate, meaning these are one of the possible estimates of cash flows. Cash flows may not necessarily exactly map out in reality as compared to what you expected it to be. So we need to have a good framework to evaluate the risk of the project. One way to do that is to do a sensitivity analysis. So what is sensitivity analysis? Sensitivity analysis begins with a base case, and then your base case scenario may say that I'm expecting to sell, let's say, 2 million widgets. I'm going to sell them at a price of $10 per unit. I'm going to procure them at a variable cost of $5 per unit, and so forth. So I have a base case scenario. Then I take all these uncertain inputs, the number of units I'll sell, the price at which I'll be able to sell, the price at which I'm able to procure it, and so forth. All of these are uncertain variables. You change it. So you change a single uncertain input variable and see what happens to NPV. See whether the NPV changes significantly or not. Okay? You keep on doing this. You keep on changing all these individual input variables and measure and record the impact on NPV. Now, if the NPV is very sensitive to changes in the input variable, then that NPV, then those projects are considered to be more risky. So you're looking at which projects have highly sensitive NPV. The NPV changes a lot. That is the key in doing a sensitivity analysis. Now, the second method is doing scenario analysis. Scenario analysis looks at multitude of scenarios, and so you could have, and this is just an example, doesn't always have to be best case, worst case, and most likely case. It could be 4, 5, 10 different scenarios also. But each scenario has an associated probability with it, meaning what is the likelihood of a best case scenario? And it's an ex ante probability. It is an estimated probability of that scenario occurring. And so you have all these scenarios, and you compute the revenues and expenses under each of these scenarios, and you compute the NPV again under each of the scenarios. That will give you the distribution of NPV. So it will give you the mean and standard deviation of the NPV. Once again, the standard deviation gives you an indication of the risk of the project. The last method and most powerful method is the Monte Carlo simulation. So what you do under a Monte Carlo simulation is simply first determine which inputs are uncertain. Out of the inputs that you determine to be uncertain, you figure out which are more critical. Okay, some inputs are uncertain, but they are not going to affect the NPV a whole lot. So you don't need to spend a whole lot of time on those inputs. But you find out the critical input variables that are uncertain. Okay, and for those critical input variables that are uncertain, you assign a probability distribution. You can say, for example, the number of units that you're going to sell is normally distributed. So you say that, okay, normal distribution is a good distribution that actually captures reality of the number of units of sales. If that is the case, you define that distribution, a normal distribution. You not only do that, you have to provide the parameters for the distribution, meaning the mean and the standard deviation for that normal distribution. So you assign all of those parameters for each of those uncertain variables. Some input variables may have a uniform distribution. Some of them may have a Poisson distribution, whatever. So you assign distributions for all the key input variables along with their parameters, and then there are simulation software packages that randomly select data from each of these distributions. And once you collect the data, a sample data from each of the distribution, you plug it into a template, and that template then will provide you with net present value. So that is one case, okay? Each time you do a sample, you get one value of NPV. And you do this thousands of times. What will you get? Thousands of estimated NPVs. And then you look at the distribution of that NPV. This will give you the risk of the project. This will give you an indication of the risk of the project. All right. So those are the three ways in which we can do project risk analysis. Once again, the underlying framework here in understanding this material is qualitative. You're not doing anything computationally. You're not generating a simulation for the purpose of the exam. So just qualitative understanding of what these three methods are, and it is also covered elsewhere in the curriculum. Now, discount rate using capital asset pricing model. Once again, one of the key elements here in this in capital budgeting is to match the discount rate to the cash flows. Earlier, we said if your cash flows are nominal, use nominal discount rate. If your cash flows are real, use real discount rate. If your cash flows are more risky, use higher discount rate. If your cash flows are less risky, you use lower discount rate. So your discount rate should match the cash flows. Now, You must use project beta if you're using CAPM. Here's your CAPM equation. You're not actually going to compute the project required rate of return using CAPM. Pretty easy, pretty straightforward. So it's not really a good candidate for a level 2 exam question. Nonetheless, the main thing here is to recognize we are going to be using the project beta, not the company beta. So keep this in mind when we when we dig a little deeper, because one of the things, one of the elements of a level 2 exam, what makes a level 2 exam more difficult, is it expects candidates to demonstrate strong critical thinking. So how are we going to demonstrate strong critical thinking? Let's go through this as a simple example. So you can have, if your project beta, and I'm going to use BC to denote company beta. So if you can have project beta that is greater than the company beta, you can have project beta that is equal to company beta, and you can have project beta that is lower than the company beta. Okay, it's the 3 possible likely scenarios. Now, if the project beta is equal to company beta, everything is pretty straightforward, not a very interesting proposition, so I'm going to take that out of the equation. Okay, when the project beta is greater than the company beta, and you erroneously simply use the required rate of return for the company instead of the project, what will you do? Well, if you're using the company beta in generating the required rate of return, well, what you're doing is you're using too low of a discount rate. When your discount rate is too low, your NPV will be too high, and you are more likely to accept this project. Once again, when the project beta is greater than the company beta, the project is more risky, and because you are erroneously using company beta in your analysis, you will accept the project. Conversely, if your company beta is greater than the project beta, meaning project beta, the project is safer, what do? You are more likely to reject it. Why? Because you are using company required rate of return, you are using too high a required rate of return, the project NPV will be lower, inverse relationship. So your required rate of return is too high, NPV is too low, you end up rejecting the project, and so you essentially make an error in your project evaluation. So I'm going to generalize what we just went through. When a company uses its own required rate of return, or the company required rate of return, to evaluate all capital budgeting projects, then what kind of error can it make? It will end up accepting too many risky projects, and it will end up rejecting too many safe projects. So that is a potential good quality question you could be facing. What we mean by that is you have 3 choices, 3 multiple choices. One of the 3 choices will say the company will end up accepting too many risky projects and rejecting too many safe projects. That would be the correct answer choice. All right, continuing on, another label to keep in mind for the required rate of return after adjusting it for risk is called as the hurdle rate. So it's just a label, but you make sure you know it. So hurdle rate is nothing other than risk-adjusted discount rate used to evaluate capital budgeting projects. And hurdle rate would be a correct rate to use. So given 3 choices, once again. So which is the appropriate discount rate to use? Choice A, the company weighted average cost of capital. Choice B, company's cost of equity. Choice C, the hurdle rate. Hurdle rate is the correct answer because that's the risk-adjusted required rate of return for the project. All right. Now let's move on to the concept of real options. Remember, options, financial options, have been covered extensively in the CFA land, but here we are talking about real option, not financial options. So real options are options that give you an ability to do certain things, but there is no obligation to do those. So again, this is a right, but no obligation. Whenever you have a scenario like that, those rights with no obligation have a value. At the minimum, the value will be 0, but it will never be negative. Remember, it's a right, no obligation. You can simply walk away if you want to. So real options are options that give you a right but no obligation to exercise certain valuable opportunities. We'll see those in just a second. They are similar in concept. Conceptually, they are similar to call and put option. Remember, call and put option, the value is at a minimum of 0. They can take on otherwise positive values. For real option, they're based on real assets rather than on financial assets. Okay, the big difficulty here, as far as at least the curriculum goes, is estimating the value of these real options. It's very difficult to quantify. One of the methods that you're expected to know is decision trees method to evaluate the amount, the value of the real options. For the time being, let's talk about first the types of real options. There are several different types of real options, though some that are defined in the curriculum include timing real options. So what is this timing real option? You don't need to make a decision today. You can choose to postpone your decision at some future point in time. So you can wait for better quality of information before investing, for example. That's a valuable option. The second type of real option is abandonment. If, for example, you realize that the project's cash flows are not going to be achieved, or if the demand for that product is not very good, you can simply exit the project early. If the NPV of continuing the project is negative, you have an option to close shop and walk away. So if that is the case, then there is an abandonment option. Another example is an expansion option, where you start out with a factory that can produce, let's say, 1 million widgets, but you realize that if the demand is too high, you can quickly ramp up production by adding more capacity. So if the production or the factory design is more flexible, that is an expansion option. Other types of option, which is simply affording you flexibility, could be flexibility in price setting. You can change the product price if the demand is too high or too low. You can also change the production. Why? You can run the plant for more shifts. You can add overtime, whatever. So all of those are considered to be real option. All of those add to the flexibility. And then finally, the last, qualitatively more definitional, if you will, the last type of real option is fundamental, where the underlying entire project is indeed an option, and the payoff on that option depends on the underlying asset. Here we have an example of a copper mine, where we can simply close down the copper mine if the price of copper in the world markets is too low. So the project is really based on the market condition, if you will. And you can reopen it if the market recovers at some point in the future. So all of these are different types of real options. So when you have a real option in a project, what you do is first we say we just evaluate the project as is. Ignore the option for the time being. Compute the NPV. Once you determine the NPV is positive, we say, okay, we'll accept it because that real option can simply add on to the value, cannot take away from the value. So it is, this project is lucrative as is, no problem, we'll take it. Step 2 is add estimated value of the option to project NPV. So value can be determined using decision tree / option pricing model. Well, for our purposes, we are really limiting ourselves to just the decision trees. Once again, we don't even need to do the estimation of value if the original project NPV is positive. Our entire objective is to determine whether to accept or reject the project. And if the NPV was already positive, then we can simply accept the project. We don't care. However, if the NPV was negative, then we need to estimate the value of the option to see if after adding the value of the option, does the project become lucrative or acceptable. Let's look at an example. Here we have a flexibility option. What you are given is the base NPV. So this is the NPV without the option, and we are trying to determine, or we have already determined that the NPV is negative 6 million. So without the option, this project would be rejected. Now there is an option, but it's not a free option. There is a cost associated with it, and the cost is $3 million. The value of that option is 10 million. So the net amount is what? 7 million positive. Okay, so the option value net is 7 million positive. When you add it to the original $6 million negative NPV, the project will have a positive NPV of 1 million. So we accept it. Okay, so that is your analysis using options, where we simply add the option value, net value of the option, to the project's NPV, and if the resulting figure is positive, we accept it. Otherwise, we continue to reject the project. Once again, the only reason we do this analysis is because the base NPV was negative. If the base NPV was positive, I don't even need to do any further analysis. I'll simply take the project. So what are the common pitfalls, or what are the common mistakes managers make while doing capital budgeting? Remember, capital budgeting is a corporate finance tool. It is used by company managers in evaluating capital budgeting projects. So some of the mistakes that managers may make include, first, failing to incorporate competitor/market response. So typical case analysis in doing capital budgeting is we assume the market is static. There is no change in the market. So when Coke wants to introduce Diet Coke, it is just assuming that there is no competitor going to retaliate or going to react to this maneuver. So that would be a wrong thing. We need to incorporate, well, what if Pepsi also introduces Diet Pepsi? What will be now the impact not only on the sales of Diet Coke, but also on the sales of regular Coke? So failing to incorporate the dynamics that exist in the market. The second element is misusing standardized templates. So companies have this standardized template with boxes for every kind of input variable, and so you have the standardized templates which may have lots of different input variables, and because of this large number of input variables, it appears that to be more sophisticated, but oftentimes it is misused. So you use those boxes even though those boxes are not relevant to the specific project that is being evaluated. The third element is pet projects are not analyzed properly. So you kind of have this biased evaluation of capital projects, where you think about evaluating project with rosy colored glasses, right? So you have all this data, and you are going to be biased. You're going to show the project in good light. You're basing capital budgeting decisions on accounting metrics such as earnings per share or ROE. So you're trying to sell this project to senior management, and you say, this is what it's going to do to your ROE or to your EPS. That would be a wrong way. Why? Because we should be using NPV in our analysis. IRR in some scenarios could be used, but generally NPV is the best method to use in capital budgeting. Another flaw is, again, using IRR for mutually exclusive projects. Remember, for mutually exclusive projects, you always go with NPV, and you select the project with a higher NPV. Garbage in, garbage out, poor cash flow estimation. If you don't estimate your cash flow very precisely without any overarching major errors, that is the way to go about it. So poor cash flow estimation will result in poor NPV estimation, and therefore that will lead to errors. Under/overestimate overhead expenses. Remember, we are supposed to do incremental analysis, okay? So our cash flow should always be incremental. So what will be the result of this new project? Will it actually add to our HR costs for the company? Will it actually add more warehousing expenses for the company? So those are the kind of questions that need to be asked. Typically, that is not how it is. Typically, we use accounting conventions, so we allocate a fixed percentage as overhead expenses, which results in errors, which results in wrong analysis. Other errors include incorrect discount rate. Key, very important. Why? Because discount rate should be linked to the risk of the project, and it has to be precise. If your discount rate is too high, NPV will be too low. Conversely, if your discount rate is too low, NPV will be too high. So that requires a lot of strong analysis, and analysis specifically about the risk of the project. Other issues include spending all the money that you have in your capital budget rather than returning it to the company. So that's just politics about intra-company departments. Failing to generate alternative investment ideas. Idea here is that you don't want to just try to find positive NPV projects. In essence, the main philosophy of running a business is to be able to seek out most profitable or highest NPV projects. Sometimes that is not what actually occurs. And then finally, not treating your cash flows appropriately related to our, again, garbage in, garbage out. So you may have sunk cost, but you burden the project with that sunk cost, which is what you should not be doing. So not treating your incremental cash flows properly would be another capital budgeting pitfall. All right? So that brings us to quote-unquote alternatives, and that is economic and accounting income. One of the things you'll see is accounting income is definitely a no-no. Accounting income, very well known. We went through FRA, and that's your accounting income, net income after taxes. However, what is economic income? That is the focus of this LOS. So economic income is your after-tax operating cash flow. Again, you're dealing with cash flows, okay, minus economic depreciation. So minus the depreciation, but key here is economic depreciation. So we need to be very precise when we define economic depreciation. Everything else is pretty straightforward. So let's do an example to understand what we mean by economic depreciation. Once again, we are dealing with computation of economic income. Let me go back to the previous slide and just define it one more time. The economic income is after-tax operating cash flow minus economic depreciation. After-tax operating cash flow, pretty straightforward. You have seen it elsewhere. But economic depreciation is a new concept, so pay attention to it. It is simply the change in market value of the company. Change in the market value is the key word here. So let's look at it. The project has a $25,000 initial investment cost. The cost of capital is 12%. You're given the 3 cash flows, the 3 years cash flows. So all the cash flows are directly given to us. What we can do is to simply compute the NPV, evaluate the project. Here, though, we are asked to compute the economic income. So first, let's compute the beginning market value. The beginning market value is $29,172. Why? Because it's simply the present value of all the cash flows. So you discount those 3 cash flows at the required rate of return of 12%, we get a total value of $29,172. Now, you compare it to the original investment of $25,000, that tells you the NPV is positive. Not only is it positive, it is precisely equal to $4,172. So that is your NPV from this project. You would accept it, right? So that is your first thing that you can directly come to the conclusion. Now, let's look at the change in market value. The change in market value is simply based on the beginning market value minus the ending market value. Now, beginning market value we computed to be $29,172. The ending market value is the value of the remaining cash flows at any point in time. So at the end of year 1, there are only 2 more cash flows remaining. So present value of those 2 cash flows will determine the ending market value. So keep in mind this $22,672 is going to be equal to $12,000 now discounted for 1 period only, and $15,000 discounted for 2 periods. So that is your $22,672. And $13,393 is simply your $15,000 discounted for 1 period. All right, so that is how we compute the ending market value. So the change in market value is the beginning market value minus ending market value, gives you $6,500. That is always going to be negative, okay? So your market value is going to decrease by $6,500 in year 1, by $9,279 in year 2, and by $13,393 in year 3. What you do then is to take that is your economic depreciation. Change in market value is nothing other than economic depreciation. Okay, and you subtract that economic depreciation from what? From your after-tax cash flows, as we just talked about. So your after-tax cash flow given to us as 10, 12, and 15, and the net amount now is your economic income. Notice the economic income always will be 12%, sorry, the required rate of return of the beginning market value. So it will always be the case. That is just pure mathematics behind it, nothing new. But the main thing here is to be able to compute the economic income in any given year. So you should be able to do that computation It's fairly straightforward. Given the cash flows, subtract the economic depreciation from the cash flows, it gives you economic income. So what about economic income? How is it different from accounting income? Remember, accounting income is reported net income on the firm's financial statements. That's your net income after tax, as we do normally in our income statement, and it differs from economic income in a couple of ways. One is it is based on accounting depreciation, so it is based on original costs and applying specific methods, single straight line depreciation versus accelerated, whatever it may be. Financing costs are not included when we do economic income, but we subtract it when we do accounting income. Now, the next LOS gets into what we call as valuation models. So this is your last LOS in this topic review, but notice it's kind of a stretch. So far we have been talking about capital budgeting, but now we kind of deviate, kind of move in a sort of tangential way, and we throw in valuation, and this is valuation for companies. Nonetheless, it's part of an LOS, so we just quickly walk through. What you will see is a lot of this material is covered elsewhere in study session 12, which we will see when you get there, but it is related to material that is covered in equity valuation. All right, so economic profit is profit in excess of dollar cost of capital. So you look at profit minus the cost of capital, and the remaining amount is economic profit. The key here is we need to subtract the cost of all capital, not just debt capital. In accounting, we subtract interest expense. However, we are not subtracting cost of equity. So here we are subtracting cost of all capital. That's your economic profit. So difference here between, remember we just talked about economic income. Difference here is that we are subtracting the cost of capital. Economic income, we were subtracting economic depreciation from cash flows. All right, so economic profit is NOPAT. NOPAT is net operating profit after taxes. So think about EBIT after tax. And then we are going to subtract cost of capital, dollar cost of capital. And remember, it is WACC in this case. Why? Because we are subtracting both debt and equity. And NOPAT is EBIT times 1 minus the tax rate. So EBIT after taxes. All right. Market value added, another metric, is simply the present value of all future economic profit. So if you can think about a company's economic profit from a specific project and you present value all of it over time, that will be your market value added from that project. Technically speaking, if all of this computation utilize the same data, if it is based on the same set of assumption, then market value added is nothing other than NPV. So that is something that you need to be able to relate. That is something that you need to make sure you don't lose sight of. So market value added is mathematically equivalent to NPV. Again, everything remaining the same, including the cost of capital. So you use the same data, same set of assumption, you should come to the same conclusion. The next element is residual income. Again, we're going to talk about this in a lot more detail elsewhere. Right now, just residual income is net income minus equity charge. Very similar to economic profit, okay? Remember, economic profit is EBIT after tax, what we call as NOPAT, minus the dollar cost of capital. Well, here what we do is net income, which is arrived at after deducting interest expense. So net income is after the interest as well as the taxes. And then now the only thing that we have not deducted is equity charge, or the cost of equity. So net income minus equity charge, that will give you your residual income. Once again, if you're trying to attribute a residual income to a specific project, then NPV is present value of all the residual income that that project generates. The last element, last approach to valuation of a company now, that's what I was talking about, where it's kind of using a stretch of where we have capital budgeting kind of intertwined with company valuation. Nonetheless, the claims valuation approach simply takes the cash flows of a company, of a business, and distributes it amongst the two providers of capital, debt and equity. So you now ascertain those cash flows, meaning the cash flows attributable to debt as well as cash flows attributable to equity, and discount those cash flows at the appropriate discount rate. Debt cash flows at cost of debt, equity cash flows at cost of equity, and total amount of value, the present value of both, will give you the value of the company. Now the cash flow to debt holders is simply what? Contractual interest as well as principal payment. All you're going to do is to take those cash flows, discount at cost of debt, after tax cost of debt, of course, and then cash flow to equity is what? Dividends and stock repurchases. These are more of an estimate. These are not contractually defined, but nonetheless you can discount the cost of equity and we get a value. And you add up together, you get the value of the firm. So what are the keys to the exam for capital budgeting? Obviously, cash flow estimation, recognizing the initial outlay, recognizing annual operating cash flows, be able to compute terminal year non-operating cash flows. One of the key elements where you make mistakes, where candidates have lost points, is forgetting to include the tax consequence on salvage value. So whenever there is a salvage, regardless of whether salvage is greater or less than book value, the tax on it needs to be accounted for. Analyzing projects with unequal lives. We talked about two different methods: the least common multiple of lives method or replacement chain method, same thing, two labels, and then equal and annual annuity method. So two methods in analyzing projects with unequal lives. Remember, again, don't lose sight of the fact that you have three conditions that need to be satisfied before you can use either of those two methods. The concept of real option, which simply add on to the value of the project. We talked about economic income, which uses economic depreciation, and we talked about alternative valuation models, where we defined new terminology including economic profit, residual income, and finally claims valuation. All right, so continue on. Do lots of practice examples on this topic, especially replacement, the replacement analysis, where we have new project versus old project. I would really put pencil to paper to get a good firm grasp on it, and charge along, keep on going at it.